Many a times in the stock market, we think that in order to make money, we have to invest a lot of money in the stock market. We have to invest 10 lakhs, 15 lakhs, 20 lakhs, 1 crore, 5 crore, and then only we can make money in the stock market. So let me first and foremost tell you that that theory is incorrect. If you invest really small amounts for a continuous period of time, it will give you compounding returns. So let me show that by jumping onto my screen and let me try to prove that point. So this is an SIP calculator. So let's say that if you're investing only 5,000 rupees a month, right? And your investment period is 15 years, right? Just 15 years, not much, just 15 years. You started investing when you were 23, 24, and I'm sure that even in your first job, majority of us should be able to save 5,000 rupees to invest, right? So if you invest this money for 15 years and your growth rate is, let's say, 12%, then how much money do you make? So you end up making 25 lakhs for a period of 15 years. Now let's change and play with this investment amount. So let's make it 10,000 because many of us might be able to save 10,000, right? So then what does that lead to? So this leads to an expected amount of 50 lakhs, right? Sounds good so far? In 15 years, right? Now, so many of us might be getting a salary of 50,000. So we might be able to save 25,000. So let's bump up the amount to 25,000 and let's look at what happens. So in that scenario, you end up making 1.26 crore in a period of 15 years. Now, many of you would jump in and say that, hey Akshat, you are not considering inflation, right? You're missing out on inflation. Yes, but here is what you need to understand, that even your salary will get inflated. So instead of investing 25,000, as the inflation grows, your salary grows, your investment amount will also grow. Therefore, I'm not adjusting this amount for inflation. So the point that I want to drive home is very simple, that even if you have little bit of money to invest, you should start doing it as soon as possible. Because this 15-year period, if you bump it up, so let's do the previous calculation to 30 years and let's do it for an amount of 5,000 only, right? So let's do it for 30 years, right? Then let's look at what happens. So this bumps up to 1.76 crore, right? So a investment period of 30 years gives you massive returns. Right? So the point that I want to drive home is very simple, that the longer you stay in the stock market, the more money you make. You don't need to invest truckloads of money, right? You can start with a very simple regular SIP and you will end up seeing those gains compound over the years and you will become very rich and you will not have to worry about money at that stage in your life. Therefore, investing is very important and this is what I'm going to cover today. I'm going to show you 3 specific small cases that you can consider investing in. It's a good option. I will discuss the pros and cons of all these 3 small cases and then you can take an informed choice what type of an investor you are, what type of risk you would want to take and what are some of the things that you need to keep in mind. And this video is catered towards people who are just starting out in the stock market. So it might be a great idea for you to watch this brief video till the very end. Please watch the entire thing because if you understand half the things and execute half the things, the results will be really bad, right? So please watch the video till the very end, understand all the concepts and I'll explain you all the concepts point by point in just 4 simple points. That's it. Nothing fancy, right? So first point is that you must understand 2 critical concepts on SIP investments, right? Now this is something that most people do not talk about. They literally go and keep doing SIPs in any kind of market, which is fine. In long term it works out. But if you want to maximize your returns, please understand these 2 concepts. So the first concept is that you must figure out what kind of market are we in, right? You don't need to do a PhD on market, but you simply need to understand that, hey, is this a bull market? Is this a bear market? Or is this a bunny market, right? So bull market means that, hey, the market is literally going up, right? Bear market means that market generally is going down. It might not go down in a straight line, but it is generally going down. And bunny market is that it moves like this, right? It just keeps moving in a particular window sideways, right? So these are 3 types of markets and you must understand what type of market we are in. So what type of market are we in? I have made a separate video on this. I'll link it here. Please check why I say that we are in a bull run right now, right? And this might be one of India's biggest bull runs. If India becomes the next China, then the growth that will happen in the stock market would be massive. It would be massive, right? So please keep that in mind, that if this actually turns out to be a massive bull run for India, you might actually quadruple your money, right? In a very short span of time. So please keep that in mind. Please watch this video. Very important, right? Now, important point is that if like me, you believe that, hey, this is actually a bull market, then you must take equity positions in the market and you must invest more in equity compared to debt, right? Debt. or commodities. Which brings me to the second concept, which is asset class allocation, right? Asset class allocation. So asset class allocation simply means that what percentage of your entire investment amount. So let's say that if you are investing 10,000 rupees, right? Then what percentage of that are you investing in equity? What percentage of that are you investing in debt? What percentage are you investing in commodities, right? So these are some of the key investment options that we have. So generally, if the market is a bull run market, then my advice is that invest more in equities compared to debt, right? And if you are in a bear run, then it's fine to invest more in commodities and debt and diversify your portfolio accordingly. But important point to note is that you must have all these three components in your portfolio in some ratio or the other, right? That is an important point to note. So this concludes point number 1, that you must understand what type of market we are in. Number 2, you must at least have a sense what asset class allocation is. So I hope this point is clear. Let's move on to point number 2. Now, let me explain this point by giving you an example, and here is a picture that you can see, right? And please type it out. Please type out your response in the comment section. I would love to read it. So here are 3 investment options, option A, B and C. In the past, option A has given 7% return, option B has given 10% return, and in the past, option C has given 15% return. Now, if you're sitting today and if I say that, hey Akshat, you have 10,000 rupees, which investment option will you pick? Your answer will be, very dumb question. I will go and invest in option C because it has been giving 15% returns. Now, this is an incorrect way of making investments. In the stock market, and this is a very important point for you to note down, in the stock market, it is very, very important to understand that past returns are not the indicator of future returns. It is fine, it can act as one of your data points in terms of making a decision that probably a mutual fund manager was really good, therefore he or she was able to make 15% return on it, but it is no guarantee that that 15% return portfolio is going to continue to give you 15% return. So please don't look at the past returns and try to estimate that since this stock or this particular mutual fund has given 15% return, it would continue to do the same. No, that will not happen. What you need to do is go back to point 1, that hey, understand the market mood sentiment and figure out your asset allocation. That is more important. So this brings me to point number 3, and I will show you 3 specific small cases that you can consider. Do check the links in the description box as well. I will put the link to these 3 small cases in the description box also. So let's move on to point number 3. So if you are a complete beginner and if you are looking to make investments in an SIP mode, right, then you can definitely consider small cases. And there are a bunch of good options for you to invest little bit of money in the stock market via the small case route. So what you can do is that you can go on this Discover tab and you can go on this low investment amount option, right? And then depending on your preferences, you can go to under 5,000, under 25,000 and under 50,000. So under 5,000, you have 3 specific small cases. So let me give you a very quick commentary on all these 3 different types of small cases. So let me open the first one up. So here you can say that, hey, in 2 years, this has given 19.11% return. This is pretty much pointless, right? This historic return. What you need to do is that you need to understand where the market is moving and then accordingly take bets. So this is an equity and gold type of a small case. Now it only has 2 different components. One is Nippon India Gold Bees ETF, exchange traded gold fund, right? So you can either buy gold in an ETF format, right, which is a digital format, or you can go and physically buy gold, right? So these are 2 prominent ways in which you can buy gold. Now here the asset allocation is 30% in gold on this small case, and Nippon India Nifty 50 ETF. Nifty 50 ETF. This means that these are the collection of top 50 stocks or top 50 companies in India. This has 70% allocation. Now, this only requires 255 rupees investment, right? And you can buy it in different units and you can scale it up. No doubt, you can buy like 10 units or 15 units. This is a very small investment amount and you can start investing via this, right? So the good thing about this is that there are only 2 types of options. One is gold, right? And one are equities. So this is awesome. This is gold. Gold you can be used for hedging, right? And equity is generally used for growth, right? So since we are in a bull run and majority of the components of this small case is dedicated to equities, this seems like a good small case in this market right now, right? Because it has low debt component, right? Debt component is 0. Now, of course, a lot depends on your age as well. If you are very young, right? If you're just in your, let's say 20s, right? Or even in your 30s, then your debt allocation need not be very high, right? Debt is relatively risk-free, right? It is relatively risk-free. Why? Because debt, What is debt? Debt is essentially when companies take loans or banks take loans or government take loans, right? So they are taking things on loan and they have to pay it back, right? But in equities, what happens is that equity, you become an owner of a company. So the company is not taking a loan from you. You are becoming an investor in that company. Therefore, debts are less risky, much less risky compared to equities. But in a bull market where we are imagining that the market will continue to grow up, we don't need to invest a lot of money in debt, especially when we are young, right? So for hedging, what are you using? You're using gold, and for equity growth or growth in your portfolio, you are investing money in equities, right? So this seems like a great small case from that perspective. The second small case that you can consider is called as top 100 stocks, right? So this is a good small case. You require an investment amount of 924 only, but here we are talking about top 100 stocks, right? That is one. Now, what are the major pain points or what are the major drawbacks of this small case? Number one, this has top 100 shares, right? So why not only go with top 50, right? So as I had shown you on the previous small case, right? That was the first thing. Why invest and go to the next top 50, right? Next top 50. So there are again some advantages and disadvantages. Usually these next top 50s would be for slightly smaller companies, right? So they are likely to give slightly higher growth rate in a bull market. So this might be the advantage, right? But again, you can say that, you know what, why should I even consider the next 50, right? Ranked from, let's say, 50 first to 100. Why should I consider this bucket? I will only invest in top 50. So this small case is not for you from that angle. Second point is that there is no hedging, right, on this. You're completely invested 100% in equities, right? And if the market crashes, that becomes a problem. So there is no hedging that is going on here. So therefore, I'll prefer the first small case over this. But having said this, this is a slightly risky small case. And if you're an investor who likes taking a little bit more risk, then yes, this small case is for you and you are likely to make more money in case there is a massive bull run that happens via this small case compared to the first one. So now let me talk about the third small case. It is called as all-weather investing. This again is a good option for investors who are looking to invest small amounts. So here you need an amount of 4,342, right? Let us very quickly take a look at its components, right? ETFs and weight. Now, what does this have? Number one, this has gold, right, which is good. This will be used for hedging, as I have been saying that, hey, in case we are in the middle of a bull run, right, if it keep going up, awesome, nothing like it. But if the market corrects, right, if there is some bad stuff that happens in the market, then at least you have some kind of a hedge going on, right? So gold acts as a hedge. Number two, this has equity component in it, right? How much of equity? It has around 47% equity in it. So this seems fine, right? The asset allocation seems to be good. And then there is 23.6% debt. So this is a well mixed kind of one option. This has 1, 2, 3 option. Now, the good part about this small case is that number one, it is very well hedged, right? You are invested across different asset classes, right? That is one. That is the good thing about this particular small case. And number two, this is all weather in the sense, and it has been named correctly that, hey, this is all weather. This is all weather because this portfolio is likely to survive in under any kind of circumstances. If the market is going up, then your equity will support you, right? It will help you grow this portfolio. If the market is going down, there is enough hedge that has been built via the gold, right? So that is the good part. If you are making your first investment and you don't want to lose out money or you don't want to lose out too much money in case something bad happens in the market, then this is a safe kind of an option to execute, right? Therefore, it is low volatility and therefore, if this is literally your first investment, it is okay. You could consider small cases like these. Now, in case you ask me that, hey, should I go via small case route or should I go via the mutual fund route? I have made a separate video. Please take a look at it. I will link it somewhere here. That will help you understand the difference whether you should be going via the small case route or the mutual fund route. Now, fourth and final point is the entire summary of this video. Number one, please don't wait for corrections to happen. And don't say that, you know what, right now market is at 16,000. I'll only start investing when the market falls at 10,000. If you keep doing it, there are still enough people waiting that the market will one day hit 7,500, right? They were waiting when the market was correcting. Back in 2020, when the coronavirus hit, there were numerous investors who just made the point that, hey, I'm only going to enter the market when the market hits 7,500 again, right? They missed that bus. Now the market is sitting at 16,000. Now, why am I so bullish on the market? The reason is very simple, that when bad news do not correct the market, it's a good time to understand that, hey, the bottom has been formed. The entire second wave of coronavirus happened in India, and tell me, by what percent did the market correct due to coronavirus second wave? It corrected very, very less. that means that the bottom has been formed. Now, unless some new event happens, right, something similar to coronavirus comes or some new thing happens, right, then it's an entirely different debate altogether, right? But looking at the current circumstances, it doesn't seem like that any major correction is going to happen from this point on, and therefore you must consider investing. Number 2, you must understand asset allocation, especially when you're a beginner. Don't just go and invest all your money in random stocks by understanding random stock tips, because you will get wiped out and then you will never ever enter the stock market again, right? So please don't make that mistake. This is the biggest reason that people do not invest in stock market, because they would have been burned at some stage or the other in their life, right? So please avoid making these massive mistakes at the early part of your stock market journey. If you do that, you will have great success, and for this you need to go and invest across different asset classes. You can pick small case route, mutual fund route, invest directly in stocks, but the point is that you must learn and invest. You must understand all these fundamentals. So I hope you enjoyed the video. In case you have any questions, comments, please drop a comment below. I will personally respond to those. Thank you so much, and I will see you the next time.